Hello, my name is Vikas Agrawal and I am the founder of Altport. Well, Alt is your alternate and Port is your portfolio management services. Now, we are emerging as one of the largest platform for investing in alternates and portfolio management services. Well, some of you who might be following our shows may be familiar with the fact that we organize these knowledge based sessions, and the whole idea of these sessions is to educate and empower the investor community as a whole. And we call it Ask the Expert Show. Therefore, we invite industry experts and we try and read their mind, learn from their wisdom. With me, I have someone very special, Mr. Akhil Chaturvedi. Akhil, first of all, welcome on this Ask the Expert Show.
Thank you, Vikas. Thank you so
Yeah.
much.
So, well, let me have the privilege of introducing Akhil, maybe for the benefit of our audience. So, Akhil brings about 2.5 decades of rich experience when it comes to capital market. Worked all his life in asset management business, and as a manufacturer, he's always been focusing on product designing, also focusing on various aspects, which is scaling up the business, which is also interacting with fund management team very closely and tracking the markets. So, what a day to start, Akhil. You have a father of deal today. So, maybe let me start with my first question, which I'm sure all our audience would like to know. Market क्या लगता है आज से?
No, so you're right, Vikas. I think a great day to shoot. Markets are up 2.5, 3%. In
Right.
fact, this is the second day they are up.
Right.
So yesterday it was up 1%. I think 3rd Feb and 4th Feb will go down in history. This was something which was long due. We're talking about tariffs which had been put
Right.
on India. You had baseline tariff of 25% and then punitive tariff of 25%
True.
because we were importing oil from Russia.
Right.
For last 3 months, we've been waiting for this thing to go through. The earlier deadline was November, then December, and then it went all over the place.
Right.
And then we get this surprise last night. And I think everybody is active, media is active, fund managers are active, and I think the animal spirits are coming back and will come back. So markets from here on, I think it looks very, very good now.
Okay. Okay.
Yes.
But Akhil, if you look at last 18 months, people were losing out their patience, and well, nobody was expecting this. It happened suddenly. But do you think that it is now sustainable? Do you think these FPIs who've been selling equities left, right, center are going to now come back in India?
See, nothing will happen immediately. Let us understand the background to how equities work. Now, essentially, for equities to perform or do good performance, you need two very critical things. One, you need very solid earnings growth, and we need very good valuations. So, you need good growth and good valuations for market to go into a bull market kind of a situation, which was exactly what happened in 2021. The markets were kind of turning around, earnings growth was building up, and the starting point valuations were very, very attractive for investors to come in. So therefore, any investor who has put money in the last 3 or 5 years is very happy. There is
True,
absolutely
true.
no issue. In 2024 is where, on a backdrop of very high returns, the valuations became expensive and the earnings growth slew down. And that has been the principal reason behind India's underperformance. Now, India has given merely a 5% return. Emerging markets as a basket has given a return of 31%. Korea, which is part of the emerging
Yeah.
market, has given 80% return.
True.
Brazil has given something like 50% return.
Yeah.
So US has done better than us. China has done better than us. Emerging markets have done better than us. So India has been the worst performing market, right? And essentially
During
the last calendar year, Jan to December 25, right? So all the bad news, what you can say, which is not in favor of market swings, is I feel behind us now. So a phase of slowdown of earnings growth behind us, because now we are seeing earnings growth is picking up. Phase of high valuations are behind us. We are now seeing very reasonable valuations across large caps, mid caps, and small caps. A lot of macro headwinds around, let's say, the US tariffs is now behind us. Budget is behind us.
True.
European EU deal behind us. I think similarly, the phase of FII selling hopefully will be behind us very soon. And sooner than later, basis all these positive developments, combined with reasonable valuations, it makes a very solid rationale for the FIs to come back, right? So imagine a situation where the domestic institutions continue to participate favorably, and in due course of time, foreign institution investors also start putting net new money. I think the liquidity will really create the re-rating of our market in the next 12 months.
But Akhil, Motilal Oswal is one of the largest asset management companies in India, and you guys are positioning yourself as equity experts. Managing about more than 1,72,000 crores or lakhs of crores. My question to you is that at this point of time, when you see these markets, currency in terms of dollar term returns, our markets are not that great, and your currency is depreciating. So, what's your views on that?
So, large part of the reason behind currency to depreciate was the perpetual outflow of the FIs.
True.
To the extent of $3 to $4 billion per month. That
True.
created a lot of pressure on the rupee. A lot of foreign money was flowing out. A part of the reason behind currency depreciation was also the fact that the US tariff deal was not going in the favor. Therefore, there was a risk that the exports to US will come down, and therefore the inflow of dollars will kind of start to reduce. So that was the second reason. Third, of course, this huge import of gold, what we have done in the last 3 or 4 months, largely Indian households, that also creates pressure on rupee, right? With relatively lower interference of RBI to protect the rupee fall, and they've just allowed the currency to have a natural flow. These were some of the main reasons why the currency depreciated. Now, in a single day after the US tariff deal has been announced favorably, we have seen a rupee appreciate by almost 1.5% to 2%. Maybe you can appreciate by another 1%. So this is also now behind the window, right? So the phase of currency depreciation also seems to be behind us. From here, I think for the next couple of years, rupee should stabilize between 89 and 91, these levels.
Right. I also want to pick your mind about the recent budget announcement, because people were expecting a lot in terms of maybe rationalization, in terms of long-term capital gain or short-term capital gain. On the contrary, we saw that our honorable finance minister actually revised the rate of STT.
Yeah.
So, what's your views on that?
Yeah, I mean, I think frequent changes in taxes, especially when it comes to capital markets, which we have seen over the last several years, right from when Mr. Jaitley introduced long-term capital gains. Prior to that, we had STTs, right? And then last year, STTs were revised. And this year, again, STTs got revised. Also, last year, the capital gains tax also moved up. So, the long-term moved up from 10% to 12.5%, plus cess plus surcharge. And short-term moved from to 20% plus cess plus surcharge. So, almost like 25% kind of number. Frequent changes in taxation obviously always gives investors no clarity. It brings about a lot of kind of instability in terms of how the taxes will look like going forward, right? So while STT is a small number, it's a rounding off. Broadly, the rationale behind why this would have been done is to desist retail investors from participating in the speculative market. So I think the reason was to move the retail investors out of derivative market.
I see.
But in turn, probably you are making it unattractive for the FIIs also. Probably, I'm not very sure. So yeah, I think that was the only negative news for at least people like us who are in capital markets, that these frequent changes, and then when the long-term capital gain or short-term capital gain is not being tinkered and STT is being moved up. So the transaction cost moves up, and that always will eat into some part of your return, right? So, but apart from that, I think it's a very good budget, honestly. I think the fiscal prudence is something which really excites all of us in capital markets, because it will make the country very strong. I think we have achieved 4.4% of fiscal deficit, going towards 4.3 and then 4.2, so on and so forth. Debt to GDP, when we are talking about US with 130% debt to GDP, we are at 56% debt to GDP, going to 55% debt to GDP. It might look very simple stuff, but it has a very positive impact in terms of long-term
Rating of the
balance
economy.
sheet of our country, and eventually it will then attract a lot of foreign investors, FDIs. When they see that there is a lot of fiscal prudence, they are more comfortable to go into geographies where these kind of strong balance sheets are there, right? So they're on the path. Apart from that, I think they continue to invest in nation building, right? So they've increased investments in building roads and ports and metros from 11 lakh crores to 12 lakh crores. So consistently they've been adding a lakh crore every year to build a very strong infrastructure, which also will help in nation building. They are investing a large part of money into logistics and defense. I think these three big items, one is security for the country, which also will become a very big export item due course of time. Defense, right? Logistics and infrastructure, they continue to do the capex in this space. So these are all the positive things. I think the outlay on promoting electronic manufacturing services to the extent of 40,000 crores, again a very, very big positive from exports point of view. So these are some of the highlights, broadly very, very positive. It may not be news headline items, but it will strengthen our country and our macroeconomics over longer term perspective. So STT is a small detractor for small set of players in the market, but otherwise I think it's broadly in the right direction.
Right. No, so one of the observation that I had when I interact to my investment team is that these FIIs were creating a lot of short positions.
Yes.
In the last 6 months more particularly, and there were no reason market to correct to the level. So maybe
Yes.
finance minister wanted to address that, which maybe a lot of people may not be able to understand the importance of it, but maybe 1 year down the line they would be able to understand that. But Akhil, you've seen in the last 26 years, to be very precise, you've seen 4 or 5 major cycles: your dot-com bubble, then Lehman Brothers crisis, and your many tantrums that you saw on the European markets. What would be your message, because you are one of the largest asset management company when it comes to alternates, both AIF and PMSs? What would be your message? Should the investor try top up their existing investments, because most of them are down to the tune of from 5% to 10%? What's your views on that?
No, it's the view is very clear. I mean, if your long-term view about India is positive, if your expectation about growth of India's economy, which we are all talking about, doubling and tripling and quadrupling in the next 15, 20 odd years, then one has to have a long-term horizon to create a lot of wealth. Now, while your horizon can be long-term, you should always look out for opportunities where you can enter at lower valuations or when markets are correcting. Obviously, it doesn't look good because your existing portfolios will be down maybe 5%, 10%. But when you're sure that after 10, 15 years, this is what the outcome is going to be, then these 1 year, 2 year or 3 year of low performances, little bit negative performances should be an opportunity rather than a fear, right? So I think the long-term story for India is intact. We are all estimating India's nominal growth to be 10%, 10 to 11% band. And if that's the nominal growth, then maybe 12, 13% of earnings growth, it can culminate into 14, 15% of market growth over long term, right? So if you are a long-term investor coming here to create a lot of wealth, then these are opportunities. But if you are a short-term investor and looking at 1 year, 2 year allocations, then the strategy will be extremely different. I always believe in having a counter-cyclical approach. So any asset class which goes through a downturn is where you have to become a buyer, right? So once these asset classes perform, if you're going to lap up on it, then you will go through a phase of underperformance and then back into performance, right? A lot of people piled onto gold and silver after gold and silver did 2x and 3x and 4x return, only to realize that in 2 days you lose 30-40% or 50%, right? So either you identify these opportunities early on, or then don't come after everything is played out. So certainly, like I told you in the beginning, India is the worst performing market. It's an opportunity. It's not to be worried about, right? So yeah, that is what I would say. I think we had a great 12-month window where one could have really participated, and all those who have put money are going to be very happy today.
Right. No, other thing is particularly what's happening in wealth management, Akhil, and I want to pick your mind there is, for example, if I'm the investor and invested in a particular PMS, say Motilal, and let's say it would have underperformed for 1 year, and then another someone else, maybe his friend, neighbors are telling that my scheme has done better, and why don't you move from one to another? Do you think this approach is really sustainable in the long run?
It's not sustainable because uh, let's say hypothetically this ex-investor has invested into a Motilal Oswal portfolio when our portfolios were on top, right? And so therefore maybe you've entered at the portfolio peak,
Sure.
and for some reason if the portfolio goes through a cycle of underperformance in the short term,
Which everyone.
which happens
Yeah.
logically, then obviously you are fearful and you may be tempted to exit out. And then what one will do is then eventually buy into another performing
Right.
product of current times,
Right. Which is
and
already
then that
run up.
product also will
Yeah.
go through. So in the process, this whole thesis behind the behavior gap of investors, which is where investor returns are lower than the investment returns, that theory comes in place. Because if you are going to buy only the tops of fund manager and you're going to sell the bottoms of the fund manager,
Right.
then your returns will be substantially lower than the actual return of the fund manager, right? So think 100 times before you invest, before you cut a check, and once you have done that, then give a 10-year cycle. You have to be invested across good and bad cycle
Well said.
to then see that compounding of 13, 14, 15%
Right.
over a longer term period, which means that your portfolio will compound 4 times, 5
Right.
times. I think that is the only way
Right.
one can avoid doing mistakes
Right.
of
Right.
getting into wrong products, right products at the wrong time.
Right. This is very important, guys, because if you don't correct your behavior and if you keep shuffling your maybe mutual funds, AIF, PMS, then you're not going to get returns. What is more important is you have to have conviction. The way we look at it at a house level is that what is the kind of earnings the portfolio level has, and based on that you should look at what kind of stocks have been bought by the fund manager. Are they really high conviction ideas, maybe going through difficult time? Maybe that is the time you should take courage and put more money instead of redeeming it from there, because otherwise you'll keep doing this window shopping and not want to create returns. So that's been endorsed by Akhil. So
Yes, absolutely.
Akhil, coming to you, what's happening in Gift City now? Before meeting you, I because we are building a platform, I saw that there are 374 Gift City products have been approved by the regulator.
Yeah.
So Motilal Oswal is one of them, and we of course allocate money there.
Yeah.
So want to understand why these NRIs should take this route, and first of all, what's your views on the industry?
Yeah, so Gift City is is something which is new, which has come up. It's a great platform now for our non-resident Indians and Indian investors to invest their dollar income into Indian assets. And you have now several manufacturers available on the Gift City,
Yeah.
which are providing you that access. Now, before Gift City, it was a bit complicated because you had funds which were probably registered in Mauritius or
Cayman
Cayman or these kind of places. Access to the funds were limited. Compliances were, a lot more opaque. Cost structures outside of Gift were very, very expensive,
expensive, yeah.
almost 25 to 30 basis
True.
points. And one very big restriction for funds or India dedicated funds registered in Mauritius were that NRIs couldn't invest more than 45%, 49% of the AUM of the fund. So beyond a level, the fund couldn't be scaled up or NRIs couldn't participate. Now, Gift is a good solution to all of these problems. One, it is a special economic zone located in India, outskirts of Ahmedabad. It has been formed to promote Indian financial services for global investors.
Sure.
Similarly, for Indian investors to participate in
Outside
global
of
assets, right? So it is a win-win for resident Indians. It is a win-win for non-resident Indians. very simple regulations, in terms of paperwork, operational
Right.
convenience, cost convenience. It's very, very, very simple.
Mhm.
And like I said, there is no cap on NRIs. So we
Right.
can have a fund which is 100% NRI fund, right? Apart from this, there are certain structures we'll talk about
Yeah.
where there is a lot of tax convenience
Yeah.
also now, which is available, which is
Right.
where a lot of mutual funds which have taken product
Yeah.
approvals.
Now I
they
want
are,
to come there.
so we'll come to that. Yeah. So
one disclaimer here,
yes,
sorry,
yes.
is that, see, we are not chartered accountant, so please don't consider this as an advice. We'll share the market practice.
Yes.
Over to you, Akhil.
Yes.
Sorry to interrupt.
So I think we are in early days. In the last 24 months, we have seen a lot of asset management companies are setting up their shops, getting licenses, filing for products.
Right.
The second tough phase is basically going out there to NRIs across the world and promoting GIFT as a platform.
Sure.
Then promoting India as a
Right.
asset class,
Right.
and then promoting the products which are the opportunities for them to come inside.
Right.
Now, to your question, why should NRIs come to India?
Yeah.
Very clearly, if you have to put your money into equities, those who are sitting outside of India have the whole world available.
True.
Now, if you want to make money, you have to invest in a country where there is growth possibilities. Now, you can count in fingers which are the countries which can give you good double-digit growth opportunities, right? So, maybe you will look at US, maybe you will look at China, maybe you will look at Europe, right? So, or Japan. So
Very
maybe
few pockets out
yeah,
of
4 or 5 countries or continents where you can actually put your risk money, risk capital into equities, right? Now, amongst all of these countries I've spoken about, we all know that India has been the fastest growing economy, right?
True.
So we have continuously for the last 5 years compounded our GDP upwards of 7%, and our nominal growth has been more like 9.5%, right? So this kind of a growth is no longer available, whether you talk about China, whether you talk about US, or whether you talk about Europe or any other place for that matter.
True.
So you're getting one country which is growing at, let's say, 10% dollar terms, nominal growth. And the other thing which is happening in India is as the economy is growing and combined with all the reforms which have been done by the government, there are a lot of new entrepreneurship opportunities, a lot of new businesses, a lot of new sectors. We all know the kind of issuances which are happening. So there is so much of opportunity available out here to
Sure.
participate across sectors.
Right.
And most of these new emerging sectors are offering double-digit growth opportunities, right? So number one, country is offering you good growth opportunities. At the market level, you have several good sectors, good themes,
Right.
supported by good promoters, good entrepreneurs. And scale is something you come to India for, right? So in the last 5 years, we have doubled our economy from 2.5 trillion to about 4.25 trillion.
True.
We are looking at 10 trillion maybe in the next 10 years. So you can imagine the kind of wealth creation which can happen here. It's going to be insane. So I think when you're creating your equity portfolio, India should be given a certain allocation.
Right.
With my experience, I know that a lot of NRIs are under allocated into India or Indian equities, right? The biggest risk which most of the NRIs face when they decide about India is not actually about Indian equities, but it is about currency. Right. So now let me tell you on currency.
How do you arrest that when you are looking at GIFT City?
So one has to be long term, whether it is Indians or non-resident Indians. Both the class of investors have to be very, very long term. Now in long term, let's say last 10 years, if an average return of a diversified flexi cap fund is about 14-15%, now that's your gross return in INR terms.
True.
If you depreciate 2.5% over 10 years, your dollar return will come down to about 12.5, right? Worst case, it will come down to 11. Worst case, it will come down to 10, right? So the gross return itself is pretty attractive for you to keep certain provision for currency depreciation. Now, in short term, when the currency actually depreciate, it may hurt you. But in long term, it will even out, right? And that is the trend we have seen in India. So every maybe every 7-8 years you will see the currency will fall down by 10-15%. Earlier, 20-30 years back, the sharp fall used to be very sharp.
True.
Right? So once the fall happens, then subsequently for number of years it becomes flat. Now, if I am to believe, while I'm not a predictor of currency, it's very difficult to predict the currency movement.
Sure.
But we have seen a 8% fall from 83 to 90-91 rupee levels. So about 8% knock in 1 year. Right? Now, with this kind of a fall and with such positive macro data points, I think broadly the currency will settle here for the next several years.
Okay.
Right? Now, if you are an incoming investor at 90 rupees, you don't have much risk in terms of losing money on currency.
Downside risk.
Right?
is
So you're equal to a resident investor. Right? If the currency doesn't depreciate, you get similar returns.
Similar.
For the existing investors, I would say keep a 3-year, 5-year mindset, because this also will kind of even out your currency depreciation. Let's say you're a 5-year investor, this will spread over 5 years, which is about 2.5%. And eventually, we are confident that a good double digit will come from equities. So long term is a hedge for all the NRIs. For existing investors, do not panic just because there is a currency fall of 7-8% or 9%. Be long term, participate in the broader
India growth story.
Yeah. And for new investors, I think the downside on currency is limited, and upside on equities is unlimited.
Right. So for the benefit of our audience, talk to us about structure. So one, you said inward funds and outward funds. Now within inward funds, I see that there's a mutual fund and there's this direct equity.
Yeah.
Now talk to us about that, and also the industry practice in terms of taxation.
Yeah. So normally you have institutional funds and you have retail funds. Right? Now in institution funds, if you have a fund which is directly managed at the GIFT City level, right? It's a proper actively managed fund. And you are under the AIF structure. Now you have 3 Cat 1, Cat 2, Cat 3. Let's stick to Cat 3 for the moment.
Okay.
Now, the taxation structure in a AIF Cat 3, which is all about long only equities, pure listed equity portfolio, the taxation works just like an individual taxation or a company level taxation, where all your trades which are short term is taxed at short term rates, which is 20++, and all your long term trades are taxed at 10% or 12.5% plus.
It is done at the instrument
at the AIF level. So the taxes are discharged at the fund level, and what the investor gets is a post tax NAV. But eventually the investor has paid for all the long term, short term, dividend. All of these taxes are paid at the fund level, and money is given after taxes have been.
What about their country?
deducted.
For example, somebody is from US or Gulf.
Yeah. Now, with most of the countries, we have double taxation agreement, right? So, once you have paid the taxes out here, you will get your statements. You can take a pass-through benefit out there, show your returns, show the taxes paid, and then you don't need to pay your taxes double, because you've paid it in India. You don't need to pay it in your home country.
Is very important.
The only country where we have to give additional disclosure, additional documentation is for US investors.
Okay.
For US investors, we issue K1 certificate, which clearly gives you different the split between your long-term gains, short-term gains, dividend, all kind of taxes which have been paid every calendar year.
Okay.
Which can be we issue the K1 every calendar year. So December 31st, K1s will be issued by Jan or Feb. You need to use this K1 to take your set off against your capital gain liabilities back home. Other positive, mutual funds.
Yeah.
Other positive thing about our AIF or those AIFs who have registered in US, our funds are categorized as non-PFIC funds.
What is that?
Which means PFIC is basically passive foreign income, which is in US taxed at 40% plus.
Okay.
If you are PFIC, right?
Okay.
Now we have registered our fund in US, and our funds in GIFT City are categorized as a non-PFIC fund, which means that any capital gains arising in a non-PFIC fund will be charged capital gains basis the local taxes which are applicable in US, which is as per slabs and all.
Okay.
So you're not going to pay 40% tax. You have to pay, I think, 15 to 17% is the average capital gain tax in US.
Okay.
India is 15 to 17% broadly. Right. So you can take complete set off. So you save that additional 25% of foreign tax. So that is something which the US investors should keep in mind, that which funds are PFIC and which funds are non-PFIC. So you can save on that much.
And Gulf
tax
is out of
outgo.
question.
Gulf is anyways, there's no capital gain tax anyways. Now the other part is a structure which is fund of fund structure.
Yeah, I want to understand more in detail.
Now
there.
this is a beautiful structure because in India, if Indian investors invest in Indian mutual funds, it's a pass-through vehicle, right? So you invest at a particular NAV, you exit at a particular NAV. There is no tax deducted at the fund level. It is a pass-through vehicle. Investors have to file for their taxes at the year end, right?
Okay.
So this is for the India. Now, what GIFT says is that if you create a fund of fund structure or a feeder fund structure, so you create a fund in GIFT, which
under AI platform.
In the AIF platform, same Cat 3, but it's a fund of fund. Now, the investment is actually then pooled into Indian mutual funds. So it's a fund of funds. So that fund is mother fund is investing into, let's say, a couple of Indian mutual fund schemes. Now, just very similar to the benefit which the Indian investors are getting, same benefit is given on GIFT. So any redemptions happening in a fund of fund is not subject to any capital gain tax. No capital gain tax, nothing at all. So the entire returns is passed on to the investors wherever they come from.
This is, you're talking about short term or long term?
No short term, no long term. So let's say you invest $100 at, let's say, year beginning, year end $100 becomes $110, and you put a redemption. So the entire $110 is put into your bank. No tax, no TDS, none of these deductions in a fund of fund structure.
Okay.
Now, those investors who are, let's say, in countries where there is a capital gain benefit, like Middle East, like Singapore, you have no capital gains in your home country, no capital gain deducted at GIFT City. Entire return is, your gross return is equal to your net return, right? Now, for those investors where there are home country taxes, you have to pay your own taxes. So at least as an asset manager, we are absolved from any kind of answers we have to give on taxation front, right? So depending where you come from, what are your local capital gain taxes, what kind of set of benefits are available to you, you can either choose to get into a fund of fund structure, or you can choose to get into a normal fund which is operated directly in the GIFT City. So
that's a direct benefit to these investors.
Yes.
So now coming back to some rapid fire questions, if you are okay.
Yeah.
Can I shoot?
Yeah, I hope no surprises.
Okay. So now I am talking to Akhil, who is a chief business officer at Motilal Oswal, who has seen the journey from 1,000 crores to about 1,70,000 crores of assets. What are your 2-3 key learnings when you really saw the scale yourself created by you as a head of sales?
So this is all in hindsight. What I've seen in the last 13 years in MOAMC, or what I've seen in last 26 years in the industry itself. This industry was 40-50,000 crores in 2000. Today it is a 85 lakh crore industry, right? You had barely few lakh investors back in 2000s. Today you have almost 6 crore investors. I think my biggest learning is that all this growth, it is seen over very, very long term. It takes 10, 15, 20, 30 years to see the scale. And the nature of our business is very cyclical. So you will have your good times and you will have your bad times.
Sure.
You have to remain, fully invested and committed through the good times and the bad times. If you can surpass bad times, good times will give you more than what you lose in bad time. So I've seen that in Motilal Oswal AMC, we have had our own ups and downs. I've seen that in the industry, we've seen several ups and downs, but despite that, the industry is growing at, I think, average of 15% over the last 20 years. And it's going to continue for next several decades, right? So just like an investor, when you invest in a product, stay put. Similar to participating in a business. When I talk to my team and or my peer group, I always say that remain committed to the industry. It will give you pain, but it will give you a lot of gain. But those who live through, they benefit and they capitalize and they compound. And those who chicken out, they lose. They
Great.
lose all
I
the fun.
understand. I understand. So number games. What is the size of AIF industry today?
So AIF all in all put together is about 13 lakh crores.
And what would be non-promoter, non-institutional?
Non-promoter, non-institution in AIFs
Yeah.
or as a market cap,
AIFs.
as investment.
Yeah.
So largely this is non-promoter, non-institution.
Okay.
This is largely HNI, super HNI, family offices,
Yeah.
money into category 1, category 2, category 3 AIF. So whether it's a private equity, real estate, private credit, listed, long short, venture capital. So these are investors' money, not
So
promoter.
keeping the institutional aside, for example, the mandate which comes from the institution. So like Cat 3 is, I was other day reading, is about 3 lakh crores now.
Yes, yes.
Cat 2 would be about one and a half. So all,
Yeah.
keeping that in mind, what would be the number
For
maybe
institutions.
non-institutional?
So non-institutions will be more like I would guess, I don't have the exact number, but maybe 70% or so.
Okay. What would be the number 10 years down the line?
This 12 lakh crores.
AIF. So I will go AIF, then PMS, then mutual fund, and then SIF.
Maybe what today the mutual fund industry is 100 lakh crores.
Wow. Amazing.
Yeah.
Coming to PMS now.
Yeah. I've combined both the things, but it's okay. PMS AIF put together, it will be a big industry.
Okay, so let's
Yeah.
take that. So you're saying that will be what?
AIFs will grow faster than PMS, I feel, because the structure is a lot more simpler. Operational efficiencies are very high in AIF.
Right.
At least we can see that AIF growth rate is faster than the PMS growth rate.
Right.
So, but let us look at combination, alternate to mutual fund structures. So, combination of PMS and AIF will compound at least 5 to 6% higher than the mutual fund industry.
Okay. Now coming back to specifically PMS. So what would be non-promoter because in PF you have in PMS you have a lot of PF mandates. So keep that aside. So what would be the size?
So PMS is about 3.5 lakh crores.
3.5, 4 lakh
Yes,
crores.
yes, on that 28 lakh or 30 lakh crores
Yeah.
of total size.
So your number 10 years down the line. Because why am I asking this question? You just said from 40-50,000 crores of total mutual fund industry, you saw yourself reaching out to 75 lakh odd crores.
Yeah. So you're talking about MOMC number?
No, 10 years industry, 5 lakh, 4 lakh crores.
So
of
3
PMS.
lakh 5 years. So I think 3 lakh PMS probably, let's look at a doubler from here.
Only.
3 to 6 lakh. But AIF, like I said, AIFs will grow at a faster rate.
Okay.
It's a incrementally, it's a preferred vehicle.
I see.
So a lot of PMS investors are actually migrating towards AIF
Right.
because it's a pooled vehicle. You have one account statement. It's very it's a nice structure for fund managers to manage their portfolio when you are managing a pool rather than managing model portfolios.
Right.
So like I said, it's a win-win for fund managers. It's a win-win for customers and eventually the entire ecosystem.
Right. Now another child of a regulator as a father, which is SIF now.
Yeah.
So what do you think the future is? What is the current size now? And what would be the size 10 years down the line?
No, I think SIFs is a new asset class which is taken birth now thanks to our regulators.
Right.
It is a great innovation and it is under the mutual fund framework.
Right.
So therefore, rules of the game are decided and all the risk guardrails have been put in place. SIFs as a platform give you differentiated portfolios as compared to regular mutual funds or what is available on PMS AIF platform. Largely, we are talking about utilizing derivatives, future and options to create multiple strategies, to hedge your risk, at the same time give you upside, right? So long short is a very important category, very large category. Globally, it is a very large category and it was difficult to practice it in a mutual fund format in the previous prior to SIF, and it was cost ineffective on a AIF platform because of taxation being at full rate, right? So now here, because it's a trust structure, so there is no business taxes on your derivative positions, right? So your post-tax return becomes very, very attractive. So long short is one category. which is, let's say, arbitrage plus plus kind of return positioning.
Mhm.
A lot of people need, everybody doesn't want to buy equity, or everybody wants 10-20% of safety net in the portfolio. So which is where this long short as a category gets built up and can be very very scalable, and you'll have,
Especially in India.
especially in India, and you'll have many SIFs which are getting formed.
Mm.
I think the first product will be long short product.
Yeah, I saw the other day the number of SIFs which have been approved by the regulator is
Yes.
about 88. 89.
Yes, we have also filed for it. I think, and the initial success has been good. I think we've raised, industry has raised about 4 to 5,000 crores. There is a lot of excitement, and there are many more strategies you can create
Right.
within the SIF. It's not only about long short, but you can create, equity plus strategies. You can create equity minus strategies. There are opportunities on the debt side. There are opportunities on the commodity side. So it's very very new.
Right.
There will be a lot of learnings that what kind of differentiated products which can
Mhm.
be created, where you can use derivatives to hedge the risk or enhance the return, whichever case it might be.
Right.
But a lot of innovation will happen on SIF, and like I said, in 6 months 5,000 crores means there is a lot of curiosity,
Appetite.
and it is also available at smaller ticket size of 10 lakhs.
Right,
So
right.
you can have a greater participation by more number of
Right.
investors, right? So yeah, I think that's something new which is building up.
Yeah. So what is the size of Gift City now, and what would be the size 10 years down the line?
That's a difficult question. I don't. Maybe you will have the answer. I don't know what is the Gift City
Yeah.
size.
So the numbers suggest that, see, at an industry level, we are witnessing about $1 million dollar of inflow
Yeah.
month on month,
Yeah.
both put together. Because out of 350, the number of active funds are only
Yeah,
60,
yeah.
65. Other
I think 30-35 billion dollars is what we have right now, all put together.
Yeah, that's
I
right.
think so.
Exact
Yeah,
number.
I
Yeah,
think
yeah,
so.
yeah.
But
So
I
what-
may be wrong.
Yeah. But do you think that this can surprise
Of course,
everybody?
of course.
And is this where you were in 2002 when you started your
No,
AMC career?
absolutely not. A lot has changed in the last 5 years. A lot has changed in the. See, broadly, like I said, the fear about investing in India are twofolds, right? One fold is that what will how the economy will shape up, political risk, growth risk, many other things. I think this is now behind us.
Right.
I think we are seeing a lot of stability. We are seeing a lot of growth. Like we spoke, a lot of entrepreneurship, liquidity building up. Domestic investors are becoming more stronger than non-domestic investors, right? So that part is sorted out. The other risk was, like we have discussed, is the currency risk,
Correct.
right? Now, as our Indian macros keep getting stronger,
Mhm.
the rupee will keep getting a lot more stable.
Mhm.
So in past, let's say if you look at 25-30 years of the currency depreciation track record, used to be more like 4-5%. I would say this is going to fall down to more like 1-1.5%.
Mhm.
So the stronger India gets, the stronger the currency gets,
Correct,
and the stronger the currency gets, lesser the risk for NRIs to lose money on that count.
Right.
The only thing is that just have patience,
Right.
be long term,
Right.
right? And there's a lot of opportunity, and there's a lot of under allocation of NRIs or foreign institution
Yeah.
investors which have actually taken India risk.
Right. No, Akhil, you would be surprised to notice that the kind of wealth these NRIs who have gone abroad and created is equivalent to the size of our economy.
Yes,
Which is
yes,
about $4 trillion.
yes.
And there was a time when they used to feel that India is not the country to be looked at. Now everybody is looking at India as the only country to be
No,
looked at.
I'll tell you, a couple of years back, I used to go to, essentially, I used to go to Middle East, right? And then we used to do road shows. If we were inviting, let's say, 100 people, 20-25 were turning up. Today, we invite 100 people, 200 turn up.
Right.
So that's the kind of interest which has come
Right.
for India as an asset allocation, right? So I think there is a lot of interest. This last 1 year was a little bit of a dampener. Otherwise, I think this Gift City number would have been much higher.
Right.
So yeah, I mean, I think the long term
Mhm.
interest for India is building up. I think with the way our the India story is becoming very very it's coming in a lot of limelight, right?
Right.
Like when we do a large EU deal, right? The kind of global publicity you get is insane.
Right.
When you have trade relationship with some of the largest countries, largest economies, it speaks quite a lot about how we are progressing positively,
Right.
and that will always create reverse interest.
Right.
But for you and me, we have enough opportunities in India.
Sure.
If NRIs come and participate, very good.
Right.
But otherwise,
Otherwise, the Indian
here
story
there
will
is a
tell.
flood.
Right. My last question, because we are running short of time. So, Akhil, now your personal thing in the last 26 years, what are your 2, 3 key learnings personally, professionally you've spoken about?
In terms of investing,
Because you always say that no, you are a student.
yeah,
No, you whatever you three
yeah.
learnings that you want to share, which has actually worked in your professional career.
Yeah, I think what has really worked for me is that always keep challenging yourself.
Okay.
The areas where you feel you are not strong,
Mhm,
you need to work on that, and you need to improve in those areas
mhm,
and try to learn. So one is investing in yourself,
mhm.
being learning mindset. So we are in a business where we have to be updated like 24/7 what's
True,
happening
true.
everywhere, right?
Yeah,
The more we are getting globalized, and when you interact with investors all across,
yeah.
then you need to be
You have to keep a track
you
of
need to be well read.
well said.
So learning mindset is very, very important.
Mhm.
Above all of things, I would say that be patient, be committed, and take care of yourself, take care of your health, and work hard, work smart. uh, be at it. I mean, just be at it. It's a marathon. Don't try to sprint.
Yeah.
Work life is marathon. So slowly, steadily, you just keep running at a pace, and you'll complete your 21 kilometers, 42 kilometers, so on and so forth.
Well said. So this is what it is. So we'd like to conclude our session here. It was wonderful speaking with you, Akhil.
Thank you, Vikas.
As always, a lot of things for me also to learn.
Thank you.
And I'm sure our investors would appreciate. So enjoy the show. In case you have any feedback, please write in the comment box. And in case you have any question for Akhil, please feel free to reach out to us. And we are happy to uh, uh, give more insights about it. So with that, thank you. Thank you so much, Akhil.
Thank you.
Thank you.